Hi everyone, this is Rohit. I'm the co-founder and CEO of Stilt, and today I'm going to tell you how the US banking system works. Every country's banking system is unique, and the US is no different. So it's important to understand where your money is going when it goes to a bank to feel comfortable that your money is safe so there are no surprises. It just helps to know how the money is regulated and sort of moves around in the system. I'm going to talk about government agencies, different types of banks, and how banks make money. Please like and subscribe if you find this video useful. Your support helps us please the YouTube algorithm gods and show this video to more people like you. The first thing you need to know about the US banking system is the Federal Reserve. So the government agencies that manage the banks. There are three agencies. One is the Federal Reserve, second is the OCC, which is the Office of the Comptroller of the Currency, and the third one is FDIC, which is Federal Deposit Insurance Corporation. So Federal Reserve is the central bank of the US. Simpler comparison could be RBI in India. They are not exactly the same, but kind of similar. That's the simplest way, the simplest comparison with another central bank, or European Central Bank in the Europe, which is ECB. So the Federal Reserve has mainly 3 or 4 functions. The first one is to regulate all the banking system in the US. The Federal Reserve tries to manage money supply. By managing money supply, they do 3 main things. One is they control inflation and deflation. Second, they control the interest rates, and through these tools, they control unemployment rates. So the Federal Reserve wants to make sure that the economy is growing well. Second agency, the Office of the Comptroller of the Currency, which is the OCC. The OCC's responsibility is twofold. One is to make sure that there is enough competition amongst the banks, and second, that the banks are accountable to the services that they are supposed to offer. So that's the OCC. Third is FDIC, which is the Federal Deposit Insurance Corporation. And FDIC's sole responsibility is to guarantee your money. Almost every bank in the US is guaranteed by FDIC for up to $250,000. What that means is if the bank shuts down or closes or takes your money and run away, then FDIC is going to step in and reimburse you for up to $250,000 worth of deposits that were in the bank account. So FDIC also works really hard to regulate banks, because if the bank fails, then FDIC is on the hook for the money. So those are the three big agencies in the US. Now coming to a bank. What does a bank do in the US? The primary function of the bank is the same across all countries in the world. First, a bank needs to be a depository institution. So what they need to do is take your money and hold it safe for you. Second, it provides credit functions to you. So it provides products like credit cards, personal loans, auto loans, mortgages, so on and so forth. So the bank needs to make sure that it is fulfilling its responsibility towards consumers by providing them good credit products. The third function of the bank is to make sure they're matching the deposits with the credit products. So once you deposit the money in the bank is kind of pools everyone's money and then lends it to the people who need them. And they obviously charge an interest rate for it. And the way banks, in shorthand, make money is by taking the difference between the interest rate that they charge and the rate that they pay for you to deposit money in the bank account. In the US, the savings rate is almost 0%, so you really don't make any money when you put your funds in a bank account. So let's talk about the banks themselves. There are more than 4,000 banks in the US. I think the exact number is around 4,700. So the three agencies that I mentioned earlier, which is the the Federal Reserve, the OCC, and the FDIC, they are responsible for managing and monitoring and regulating these 4,700 banks in the US. US is one of those countries that follows a dual banking system. So what that means is there are nationally chartered banks and there are state chartered banks. It's easy to recognize a nationally chartered bank because they are required to have like national or federal in their name. And with one charter, they are able to serve customers across all of the US. And they are managed by the Federal Reserve and the OCC primarily. Now, state regulated banks have charter only for to operate in a certain state. For example, if you're in Texas, a state charter Texas bank can operate only within Texas. These banks also have to comply with the state regulations. There are usually Department of Financial Institutions or local Federal Reserve boards to manage these state banks. So those are the two main types of banks. Most of the banks in the US most of the big banks in the US are nationally chartered. The smaller banks like your community bank and the like may be only state chartered. So make sure, depending on the type of life you have in the US, if you are gonna move across the country or move between states, it's better to have an account with a nationally chartered bank. Now let's talk about the different types of the banks in the US. There are 5 major types of banks in the US. The first one is a retail bank, second is a commercial bank, third is a credit union, fourth is a savings bank, and fifth are the more up and coming neobanks. Let's talk about them one at a time. Retail banks. So retail banks are your normal run-of-the-mill banks with branches. Examples include JP Morgan Chase, Bank of America, Wells Fargo, Citibank, PNC, so on and so forth. So these retail banks primarily serve retail customers, which are individuals like you and me. They also serve small businesses, so you can open a small business account, and they also sort of serve big businesses. But their primary function, or most of their accounts, are usually with retail customers, and that's why they are called retail banks. The second type of bank are commercial banks. So these types of banks are primarily focused on serving businesses. There is not a huge distinction between retail and commercial banks, aside from the fact that commercial banks try to focus mainly on businesses and not serve retail customers, even though they can serve individual customers. It's just the business model that they have chosen to serve mainly businesses and large companies. The third type of bank are credit unions. Now, they don't have a bank in their name, but usually you'll see a lot of credit union associated with your university, your employer, or the community that you are living in. Credit unions are additionally regulated and monitored by NCUA, which is National Credit Union Association. Now, credit unions are non-profit organizations, unlike retail banks, commercial banks, savings banks, and neobanks. Credit unions require someone to open an account with them, so be a member of their credit union if you want to access all of their services. So you can go to a retail bank, let's say like a JP Morgan Chase, and try to get a loan from them, even without having a checking account with JP Morgan. But you cannot do that with a credit union. They would want you, or they would require you to be their member. So opening a checking account with them, depositing your salary in the credit union before you can actually take a loan. The next one are savings banks. These banks don't necessarily function as someone's day-to-day account. They usually try to acquire customers or get funds in their banks for savings function. So you can, and they generally offer higher interest rates than your normal retail banks and credit unions for savings and checking accounts. So people generally just park their money in these savings banks, and they offer slightly higher interest rate. They are not usually, they may not give you a debit card. They may not have a lot of other functions that you may need from a normal banking account. The last ones are neobanks. So neobanks are more up and coming, primarily online only banks, which offer you services through an app. And they are generally built on top of these smaller state chartered banks or credit unions or community banks, and they provide you services in a more seamless way. All of these banks, including the neobanks that I mentioned earlier, are FDIC insured. Most of them are FDIC insured. So funds deposited in any of these bank accounts is guaranteed by the Federal Deposit Insurance Corporation for up to $250,000. So these are the 5 types of banks: retail banks, commercial banks, credit unions, savings banks, and the more up and coming neobanks. Now let's talk about how do these banks make money. As I briefly mentioned earlier, one of the primary functions of the bank is to provide credit services, is to lend money to customers. And the way banks make money is they take your deposits, they pool them together, and they lend to people who need to borrow. So when you deposit funds in your bank account, your bank may offer you a very low interest rate or a slightly higher interest rate. It can go from anywhere from 0.03% to 1% in these times, but it can go as high as 1.5 and 2 to 3%. But there are hardly any banks that offer those high interest rates, including savings banks. But once you deposit the funds, the banks sort of have this pool of money, and another set of consumers who need to borrow come to the bank, and bank lends to them, charging them depending on the product. Like credit cards are average 15%, personal loans are average 10 to 12%, mortgages are 3 to 4%, so on and so forth. So banks lend this money to customers, and then they make the spread. So they are lending at an average of 10 to 12%, but they are paying you for deposits only like 0.03%. So they make a spread of 10%, but the bank has to function, has to meet all its obligations, has to pay salaries, has to pay for branches, and everything from that 10% spread. So it is in the bank's best interest to have a lot of money sort of out as loans to customers and a lot of deposits. The bigger the amount is, the better it is for the bank. And the biggest bank in the US is JP Morgan, has more than $3 trillion in assets, including from consumers and businesses. So banks are able to make hundreds and billions of dollars. The big banks are able to make billions of dollars in revenue because of this interest income. And that's the primary way that banks make money. A lot of banks also offer brokerage services. So if you want to invest money, you open a brokerage account with them, and then through that brokerage account, you are able to invest in mutual funds, ETFs, stocks, so on and so forth, and the bank sort of facilitates that for you. So that's primarily how all the banks make money, but the majority of the revenue comes from the interest that they earn on credit cards and loans and auto loans and personal loans. What do you need, like some of the terms that you need to know about to make sure you have a good banking experience in the US? The first term is fees. Unfortunately, US banks also charge a lot of fees, which is highly undesirable, but it's important for you to be aware of what those fees can be. The first fee that almost every bank charges, is an overdraft fee. What that means is, if you have $100 in your account and you swipe your card or you make a transfer of more than $100, then the bank may front you the money or may lend you the money for a few days for that amount. So for example, let's say you paid for something and it cost $110. but you only had $100 in your account. So the bank will front you the remaining $10, but it charges you a fee. And that fee on average is about $35 in the US. And that's considered an overdraft fee. The second type of fee is insufficient funds fee. So in the same case, you have $100 in your bank account and you go and you buy a thing for $500. The bank will not approve that transaction and return and fail the transaction from wherever you are trying to sort of buy something. In that case, again, you won't be able to buy something, but bank will still charge you $35 insufficient funds fee because a transaction was returned. So the second type of fee is insufficient funds fee. Now, the third type of fee is your monthly account fee. And banks in the US generally want you to have a minimum balance in your checking account or savings account, or they want you to set up direct deposit, so money coming directly from your employer to the bank account. In that case, if you are not fulfilling the minimum balance requirements, the banks may charge you a monthly account fee. And they go anywhere from like $10 to $15 to $20. Which is again like not desirable because you may not have enough money to deposit in a bank account, but that's the third fee that you are charged. And you also need to be careful when you open a bank account. The banks may waive off that fee for a period of time, but without you knowing, they may start charging that fee after let's say 6 months or 12 months, or maybe even after 24 months. So these are the three major types of fee that you need to be aware of. The last thing you need to be aware of is how the funds are transferred from a bank account in the US, and that system in the US is called ACH, which means Automated Clearing House. The salary that comes to your bank account, the credit card bills that you pay, there are some other bills that you will pay through your bank account are deducted through ACH. As a general principle, anything that you are paying that is not from your card generally goes through the ACH system. And the ACH system is a slow system in the US. So if you make a transfer today, it may take up to 3 business days for the funds to be deducted from your account or for the funds to arrive in your account. So make sure when you're doing transactions, you know what's the timeline for the funds coming to your account or funds going out of your account. So these are the main things that I wanted to briefly share with you about the US banking system. As a recap, we talked about the 3 main agencies in the US. One is the Federal Reserve, the OCC, and the FDIC. We talked about the dual banking system in the US. So nationally chartered banks, state chartered banks are the most common ones. Then we also talked about different types of banks in the US: retail banks, commercial banks, credit unions, savings banks, and the more up-and-coming neobanks. And then we talked about how the banks make money, kinds of fees that they charge, and how you can make sure that you are not charged any fees. So that's pretty much it for today. Again, please like and subscribe our channel if you found this video helpful. We are always putting out more content to help immigrants and visa holders build better financial lives in the US, and your support will be highly appreciated. Thank you.